Welcome to the ProVest Pulse. I'm Gabe, he's Noel, and welcome everybody to episode 4. We are recording this on May 12th, around the end of the day. So apologies it took so long. I'll get to a little bit why I was a little late, a little bit of vacation, a little bit of business, but always great to get back into this with y'all. We have some great data to cover, and one of the feedback that I got was you guys want it to be a little shorter, so I'm going to make this as fast as I can. I'm aiming for about 15-20 minutes, and if it needs to be shorter than that, please let me know. I'd be more than happy to kind of condense everything down. So let's get to it. Tons of information. Quick little housekeeping things I want to go over with y'all. Our website is currently getting revamped, so if you go to our website, you'll see it a little bit differently than one might expect. So feel free to click around, check it out, see what you guys think. And another big thanks to everybody who showed up to the event, the First Trust seminar. As you guys might know, I wasn't there. I was on vacation and also traveling with my dad to visit some other firms and talk and just get a bunch of information, learn a bunch of stuff. But Noel, how did that go?
Oh, it went great. We had a good crowd and the speaker was right on point. Everybody, actually, half the people stayed after it was over with so they could talk to the speaker and ask him questions. He really hit a nerve by telling everybody about what's going on now, the geopolitical aspect of what's going on in the Gulf and what's happening with gas prices and how that affects the whole market, how that affects everything in the rest of the market. And so the people that came really, really enjoyed it.
Good. Well, I need to make it a note to make sure that I show up to the next one because I'm really sad that I didn't go to this one. But glad everybody had fun and glad that was really awesome to hear. Now, where I was in Destin, Florida and Miami, Florida with my dad. You'll see my dad in the top here on this little jet ski. We went, just enjoyed the waters and the sand, took a week to visit the family that I haven't seen in a little bit. So just a couple of photos of us traveling up and about. My fiance, Michaela, on the back of my jet ski, and you get to see my dad and my mom in the other one. Hopefully I'll get better pictures of them in the future. But also one of our highlights of that trip was the Blue Angels. I took this at a very quick notice because I realized at the end of when they were doing their little tricks, like, maybe I should take a photo of this so people could see how cool this was. But talk about rattling your eardrums. I mean, that was just really fun and just noisy to be a part of. Couple of extra photos. You get to see my siblings playing on the beach. Beautiful blue waters, beautiful. You guys haven't been to Destin, Florida, highly recommend you go. End of April, early May, where the kids aren't out of school yet, and it's a little bit on the it's more towards the end of, or the beginning of the tourism cycle, so not a bunch of people are there. I took this picture of Michaela because she does not like sharks, and I wanted to see if I can get a picture, a little bit of a cringy face. And she also, on the bottom left picture here, she made these little, I've never heard of this before, but if you get to become a bridesmaid, then the bride makes, will you be my bridesmaids or will you be my bridesmaids boxes? And it was really cute to see her make that and give that to my sisters during this trip. So that was really cool. But now for the data, all the good stuff that you guys came, quick quote of the week. If you want to have better performance in the crowd, you must do things differently from the crowd, from the master himself. If you also have time, he recently did an interview with CNBC on the investing environment. Highly recommend everybody check that out on YouTube. So what we're seeing right now is, if you guys have been tuning into your accounts, you'll see a massive spike. We've all seen markets raise at a very brisk pace compared to what we saw in the last episode. So don't want everybody to get complacent. I want everybody to know that we're not currently complacent at ProVest. We're making sure that things are looking good. But a couple of indicators I want to point on. Put call ratio. Last episode, you guys heard me talk about the put call ratio being the highest it was since 2020, or even past what 2020 was. Just meaning people are buying a bunch of insurance on the market while it's already on fire. After the rebound, we now see nobody buying insurance and nobody's buying protection, and everybody's now investing in. So something I really take to heart right now is be fearful when everybody's greedy, and then be greedy when everybody is fearful. If you were greedy when everybody was fearful, right when the world started to freak out with the geopolitical tensions, you were handsomely rewarded with, I think the S&P raised 13 to 14% during that time. So it's just something to keep in mind. VIX is being mid-teens, isn't going too far. Something I really want to highlight real quick. Complacency.
Now, what is the VIX?
The volatility index. I'm glad you pointed that out. So when the VIX spikes and you have a high VIX number, that means the volatility in the market, the ups and downs, are much greater than what people normally see. So glad you pointed that out so I could explain that real quick. Personally, we're remaining mostly invested. This isn't a risk-off call, but it just means we're keeping our hands on the trigger on what's moving the market right now. So it's just something that we're looking at day to day. The rotations. So something that I want to talk about a lot. Defensives are very, very out of favor right now. And there's a slide that I want to go over real quick. But defensives are a much smaller portion of the S&P 500. Things like food, beverage, consumer staples, healthcare just are not as prominent as they are. Everybody's going after tech and still going after software, even the shiny objects right now.
Well, and AI, of course.
Yeah. Well, that's the talk of the town.
You know, everybody loves AI and everybody's talking about AI, and it just makes it to where AI is very expensive.
It's the talk of the town, Noel. I know you're excited to hop more on AI. That being said, everybody heard about a year ago that this would mirror the tech bubble that we saw in 01. And it's starting to become more like that. And I'll go over why I think so in a little bit. But it's mostly because in 01, when I was reading about Warren Buffett, he saw that the internet, the hype around the internet was changing everything. Staples and consumer staples, healthcare, utilities became way, way undervalued. The indexes did not take in too much consideration about these sectors at all. Everybody was buying pets.com, rocks.com, internet stocks. So this is starting to mirror that, which just means, this little bullet point in this third box from 2000 to 2003, defensives outperformed massively while the NASDAQ fell 78%. So while, if you guys look back at articles in the 2000s, you'll see some, has Buffett lost his touch? Is Buffett losing his magic sauce because he was investing heavily in consumer staples while they were still going down, while the tech sector and everybody was enjoying the internet high. And Buffett came out with the 3 best years he's ever seen, because while everybody's account was down 50, 60% because of the internet bubble, the dot-com bubble, he outperformed massively and produced great returns for Berkshire and all of his investors. So that's something that we're starting to mirror, and I'm keeping a close eye on and talking to Noel about. Quick little bullet points on what everybody did in 1999, 2000, and what Buffett did during that time frame as well. We're starting to see some mirrors into this realm as well. So while everyone chased tech in the 99, 2000, the most disciplined investors were buying where nobody wants to buy. And right now, that is the defensive sector. So we're keeping an eye on the defensive sector, doing some research on what might be interesting and how we can play a part in that. But we're still invested into, depending on the models you're in, still invested into certain sectors of the market. This was a chart that I want to go over real quick. So the S&P 500 defensive sectors market cap weight, this includes consumer staples, healthcare, and utilities. The 3 biggest buying opportunities: the 1980s, whenever you saw that crash, the dot-com crash in the 2000s, and we are now below where the dot-com weight was and the 1980s weight was. So we're now way below the mean of where it should be. All the money right now is into IT and all the cool stuff, but everybody's ignoring consumer staples, healthcare. A lot of people are forgetting that with the baby boomers, and Noel, you can talk a little bit about this. Healthcare is only getting more expensive.
First of all, explain to the viewers here what the defensive sector is.
Yeah, well, that is consumer staples, healthcare, and utilities. So I can't talk specifics, but any of the stocks where the companies have been steadily growing, they're doing things that everybody knows that is stable. Your beverages, your food, your surgery equipment, for example, your energy, utilities, water.
The hospitals, the hospitals that are run. I know that my mother-in-law was going to be taken to the Greer Hospital the other day, but they were full. Well, that tells you something about healthcare. The hospitals are closed to full. You got all these data centers being built all around the country, and I think we're trying to stop them here in Spartanburg. Stop some of them in Spartanburg, and because of how much energy they'll take. And so utilities are down. What does that tell you?
Yeah.
It tells you that we should be, looking at things that are currently down, but they're coming back.
Everybody's buying into it. Like you said, the hospitals are at capacity. Your age bracket is currently buying a bunch of healthcare, supplements, medicine, machines. Everybody wants to live to be 100, but that costs money. And a lot of people are reaching to that status, but the prices aren't matching what the spend is doing there.
I plan to live to be 100.
Oh, I believe it. I think I think you're going to be in the 200 range.
And so far, so good.
I like the joke that you told in one of our meetings. So I plan to live forever, and looks left, looks right. And so far it's going all right. I forget, you said it much better than I did, but I love that. So just to go over real quick, some interesting data points on the defensive sector. That sector includes staples, healthcare, utilities. It now represents just 15% of the S&P 500 market cap. It is the lowest weight since the tech bubble in March of 2000. So it was at 35% around the 2000s era. Now it's at 15%. Healthcare specifically went from 16% a couple of years ago to 9%. And the year 2000, that's the last time this whole drop occurred. So what does this all mean? As Noel and I talked about, everything looks to be growing in that business. We're all going to still need energy. We're all going to still need water, including the AI. I mean, data centers are popping up everywhere, and that's only going to get more important. But why are prices down? Why are the stock indices down? Why is the defensive sector not being looked at again? Well, everybody's looking at the cool things that are making headlines right now.
They're not the shiny object right now.
Yep. So that's something that we're taking a look at, and I would highly encourage everybody to take a look at the defensive sector. Just read about it, and what do you see in your daily life to where the utility companies are doing, how they're performing, what your hospital is looking like currently, and where you buy your food. Is the aisle in your shopping, in your grocery store, is that aisle mostly bought out? Can you tell that they're restocking as fast as they can? Can you tell that those are new items on the shelves consistently rather than really old items on the shelves? So something to keep an eye on. Another fun thing I wanted to point out. So this is the S&P historical sector weights going back from 98. Gosh, that was when I was born. I am old.
We're not 98 was yesterday.
98 felt like an eon ago to me.
1998 was yesterday.
Feels like an eon ago. I need to get into the time moves. I need to get into the time moves fast camp. So that all being said, going back to 98, the healthcare sector has been averaging, the mean of the entire indice in healthcare is about 12 to 13%. We're looking at 12.9 currently. Healthcare is well below the 2000 mark. Now, everybody tell me if we just don't care about hospitals anymore. Do we not care about getting surgeries or getting Band-Aids or going in to feel better? Because the market says we don't. Market says, or what the industry is telling us, that we'll live forever already. Well, our current things are going great. So why is it gone down so significantly? Only we can make assumptions and opinions, and this is all opinions, not advice. Consult your financial advisor. And on the contrarian side, on the IT department, we look at the historical average of that. It is well above the mean. IT is now representing a little over 35% of the S&P 500. So something to keep an eye out on why this is and why that's going on. And this was brought by NDR, Ned Davis Research. Really great people to look at some research with. Chart that I want to quickly go over. This is from RBC. Great people to get data from. The generational trends and cycles are on average since 1925 are lasting 16 to 18 years. So we're seeing pockets of deflation and inflation, and then reinflation. Every 17 years, you'll see a kind of a flip on what it was the past 17-year cycle. Currently, you'll see that the graph, we're in about the midpoint of the reinflation cycle, meaning we still have about 6-7 years of assuming this cycle keeps up past performance. Now, it doesn't necessarily mean future results, but if we can take history as a past indicator, we can assume that we're going to keep on this trajectory from here on for a little bit. And then we're going to also be hitting the deflationary period in the next cycle. Noel, do you want to add on anything to this?
No, it's just that it looks like these cycles just happen, and we've got to be ready for them. And it looks like we're in a cycle of growth at this point.
Yep. As the index has been moving through periods of expansion and contraction every 16 to 18 years, we want to keep an eye on where we're in the cycle that we're going, and then where we're going to be in the future. And some people might ask, well, Noel or Gabe, what's going to happen when we hit this deflationary cycle? How are we going to go through this stagnant growth? It's not looking great. Something I want to point out to you guys specifically is something that I learned while studying for my exams: dollar cost averaging, continually investing into, let's take the indexes, for example. I'll show this into the next slide. Dollar cost averaging is a great way to kind of combat the cycles that we might be getting into in the future. So, for example, from the 1930 to the mid-1950s, the S&P was only up $2 over a 25-year period. And Noel, I think that's called the lost years, I think is what it's called, correct?
Yeah, I think so.
So while the indice has only gone up $2, if you were to buy, from 1930 and then hold it till 1955, you would have only made $2. If you were to continually dollar cost average that investment throughout this time frame, the annualized return would be 11.7%. So this all assumes you're consistently putting in.
And that doesn't make a whole lot of sense, does it?
No. But think about
it. But if you take a look at the beginning, if you're dollar cost averaging in, you put in your $100 a month, $1,000 a month, whatever you're doing at the very beginning. Well, that first investment goes, just way down. And so from 1929 down through 1932, you've got nothing but losses. But if you take a look at when it gets back to where it was in 1954, it's only $2 from that peak to another, to that high again, or to that, a little bit more than that high again. But the thing of it is, most of that time is spent growing. Mm-hmm. Because right down next to 1930, just a little bit beyond that is where you hit the trough. And then from then on, it's growing. So that's why it goes from basically zero return to an 11.7% per year, which, the S&P 500 is averaged making over 10% a year. And so those were pretty good years if you take a look at them from a dollar cost averaging standpoint. And dollar cost averaging only means that you put the same amount of money in the same investment over a period of time, at regular intervals, like every month, every quarter, every year, something like that. And that's what it means. That's all dollar cost averaging is.
Yep. And you're buying when the prices are high, you're buying when the prices are low. So at the end of the day, if we were to go through this cycle again, like the previous graph showed, if we were going into a deflationary stagnant period, you would be buying on the worst days, which would look much better on the better days. And you would also be buying on any dips, any raises. It consistently gives you, not only is it a great behavioral thing to do, but mathematically it will present you much better returns in the long run. So do something.
And if you look from 1970 to 1980, you're also looking at a flat period, basically a period of flatness right there. But look from 1900 to 2020. What is the general direction? Mm-hmm. And that's why we've always said, think of the stock market. When you imagine it, imagine a little boy walking up a flight of stairs with a yo-yo. Too many people look at the direction of the yo-yo, not the direction of the little boy. Mm-hmm. And that's why it's so important to look over the long term and see what happens.
I like that analogy. I want to see if I can make some sort of graphic with that analogy. I really like that. So all this really means, if you were to just hold your money into cash, if you were just to wait it out and hopefully wait till whenever the market starts to recover, you're going to be missing out on opportunities like that. So today we're hovering around 5,600 for the S&P 500. If the previous graph is to show us anything in particular where we could be at the end of this cycle of uptrend, we'd be looking at about 14,000, which sounds insane. It's double than what we're at currently. But if you think about the average annualized return, if we take that 7 years and we average 10% over those 7 years, which is not impossible, but this is an assumption, you get a double. So while it's crazy to think about, if we're going to follow on the trend that we're seeing with RBC and the research that they've done and what history has told us, what the markets have done in the past, it's not super crazy to think about, but something that we're looking at. At the end of the day, y'all, I want you to think about this. Price is what you pay, value is what you get. If you chase the shiny objects and everybody's coming at you, asking you for this stock for an X amount of money, we think about buying stock a little differently than how we would buy businesses. If you were to go to your local restaurant and say, hey, how much revenue do you have? And then they'll tell you they make $100,000 a year. And then you ask, okay, well, what does the business, how much would it cost to buy the business? And then they tell you, it's going to cost you $20 million. Well, how does that make any sense? You're going to charge me $20 million for a company that's only producing $100,000 in revenue? How does that make any sense? But everybody does it on their stock accounts every single day. It's whatever the shiny object is, and that's what we're kind of seeing. But at the end of the day, just think about, we're currently thinking about, and I encourage everybody to think about the price of what the company is selling at, or the indice, or the ETF, or the mutual fund, and then what the underlying value of what you're buying is. Ignore the shiny headlines, ignore the cool things. Let's look at what it's actually going to present to you. Anyway, I encourage you. Thank you, everybody, for sending in quick remarks about the length of the episodes. I really appreciate that. Please feel free to reach us out for other questions in the future. I'd be happy to answer the questions on this webcast in the future, so we can always go back to previous webcasts and see what me and Noel were answering in the past and how we can improve on that advice. But yeah, any closing remarks, Noel?
No, I just think that hearing from us every now and then is something, and you should plan to do it. You should plan to listen, because Gabe comes up with some absolutely fantastic figures and facts that give you insight into what the market's doing. And Gabe, it's really good that you do that. And I for one appreciate knowing this stuff, so that our clients can make better decisions.
Yeah, and I love doing this, and I feel free to anybody to kind of, if you want me to cover a certain topic or you want me to look into something specifically. I know some clients called us about certain stocks in the future and want some opinions. Feel free to let me know if you want that added on to our little radio show and or I guess this is the video show. I'm so used to talking on the radio, but yeah, be happy to talk about it. Anyways, y'all, thank you so much for tuning in. I ran a little bit past my 20-minute goal, so hopefully I wasn't too boring. But take a minute, pause your video, go over our important disclosures and just quick little legal disclaimers. And thank you so much all for tuning in. We'll be back next time for episode 5. And until then, don't just invest.
ProVest.